Diversification, one of the most commonly misunderstood concepts in all of finance. One of the best ways to diversify a portfolio with a large sum of money isn't necessarily to pick a lot of different stocks and put a little bit of money into them. At some point, if you have a lot of money and you start to put it a little bit into each stock, you can end up with 30, 40, 50 stocks, and it's very difficult to keep track. Instead, what we do is we have a group of stocks and ETFs that have low correlations to each other. What does that mean? Well, let's say you have $1 million and you have a selection of all these different stocks. Instead of trying to pick 50 or 60 different stocks, pick the ETF, which is an exchange-traded fund that already has those stocks in it, that best represents the type of stocks you want to have. Then incorporate some non-correlated underlyings, which, if you're investing a lot into stocks, consider precious metals or bonds. Those instruments, although not stocks, may help mellow out the portfolio volatility. Let's say if the stock market has a bad day, the bonds may have a good day, or gold may have a good day, and vice versa. Diversification is a term that's commonly thrown around in the investment space to refer to a quality portfolio. Obviously, if you hear somebody say, I have a diversified portfolio, that's a lot better than somebody saying, I have an undiversified portfolio. But what does diversification actually mean? Well, the whole purpose of diversification when it comes to finance is to mitigate the risk in a portfolio, not so much about amplifying returns. And a lot of people get that backwards. When you diversify a large or small portfolio, it's less about cramming as many things as you can into one portfolio and more about choosing the same quality ETFs or stocks or bonds that you already have and layering into them at a proportional rate as the portfolio grows.